This voice is taken from an article with the title, "What is RSI and Who Discovered It?", which has been published on TraderTalks.net. RSI, or Relative Strength Index, is a popular momentum indicator in technical analysis. It was developed by J. Wells Wilder Jr. in 1978 in his book, New Concepts in Technical Trading Systems. RSI is a popular oscillator used to measure the speed and NGE of price movements. It compares the magnitude of recent gains to recent losses in order to determine if a security is overbought or oversold. The RSI oscillates between 0 and 100 and is considered overbought when above 70 and oversold when below 30. The RSI is calculated using the following formula. RSI equals 100, 1 plus average of upward price change, average of downward price change. The average of upward price change is calculated by adding the closing price on the current day to the closing price of the previous day and dividing it by 2. The average of downward price NGE is calculated by subtracting the closing price on the current day from the closing price of the previous day and dividing it by 2. The RSI is most commonly used to identify overbought and oversold conditions in the market. When the RSI rises above 70, it indicates that the security is overbought, and when it falls below 30, it indicates that the security is oversold. Additionally, some traders look for divergence between the RSI and price movements. This occurs when the RSI moves in the opposite direction of price movements. In conclusion, RSI is a popular oscillator used to measure the speed and change of price movements. It was developed by J. Wells Wilder Jr. in 1978 in his book, New Concepts in Technical Trading Systems. The RSI is calculated using a formula that compares the magnitude of recent gains to recent losses in order to determine if a security is overbought or oversold. Additionally, some traders look for divergence between the RSI and price movements.